What up, everybody? Thanks for being here with us today. We're going to start in about 27 minutes with former hedge fund trader Chris Capre. Sure, a lot of you guys have already heard from him. I'm pretty sure. Basically, Chris Capre, chief educator at our Benzinga Option School. We are launching this right now, baby, today. So if you guys are in the pack, welcome. Congratulations for being one of the first ones here. You're sitting at the table with the people you need to be. If you want to learn about options from a former hedge fund trader like Chris Capre, stick around. We're going to start about 5 p.m. Eastern, guys. Ladies and gentlemen, welcome to today's session. Special VIP with me in the back, former hedge fund trader Chris Capre. Very sure a lot of you guys have already heard him or, you know, seen his name around. That's right. Chris is going to be here with us. Um, Chris is the lead chief educator at the Benzinga Options School, guys. So basically, Chris is going to be with us today. He's ready to go in the back. In the meantime, please go ahead and put in the chat where you guys are tuning in from. Let us know where you guys are tuning in from. I see Alexander's ready to go. David's ready to go. Kylo is ready to go. That's great. I'm really pumped up, guys. There's so much work put into this to come out and be a reality. Shout out to Neil and Vin, all the developers that made this possible. Shout out to Chris Capre, your educator. He's going to be with us today, and we're going to chop it up with him. Let's see. People from LA, Toronto, Colorado, Florida, DC, Houston, Texas. All right, Detroit, like it. I love it. Wisconsin. All right, guys. So we have people from all over the world. That's pretty standard here for what we do. Now I'm going to go ahead and see if I can bring on Mr. Chris Capre. Let me know, Chris, whenever you're good to go.
I'm good. Can you hear me?
Hey, how are you, Chris? How's everything going, man?
Very good. And yourself?
I'm really good. I'm happy we're doing this with you. I'm glad that you're going to be here, the options educator. A lot of people have been asking for this, and it's about time we delivered to the retail folks.
Yeah, I'm looking forward to it. I've been presenting with Benzinga for now almost a year. And very early on, I felt like there was this need for this and there was the interest in this. And I've been wanting to bring a different level of options education, and unique experience and methodologies and practices to the market so that traders could really take advantage of options trading. And so now, after months and months and months of persistence, it's finally coming to the fore. So I'm very excited about it.
Absolutely. And as somebody that has followed you before this, I can definitely speak to the analysis that you put into trading options. I think it's a great ad for the Benzinga community. So for those that do not know you, Chris, or your background, I'm pretty much familiar with it. You're the founder of Second Skies Trading. You've been very successful in the options world. But for those that are not familiar with you or your background, if you don't mind, just give us an introduction, brief summary here of your experience in Wall Street as a broker and everything.
Sure. So I have been trading for 21 years professionally. I was a broker on Wall Street. I was actually at FXCM, and our offices were on Old Slip, which, if you know Lower Manhattan, it tees with Wall Street. And so I was with them from 2004 to 2006. I worked on the US desk in the New York office, and then I went to the San Francisco office to start that office, help them build that up. And I worked on the US and the Asian desk there. And after working for them for 2 years, I got an offer to trade for a hedge fund. It's called the JNF Hedge Fund. They were located out of California at that time. And, in 2007, I decided to go private. And so I have institutional experience. I've traded everything under the sun. And I do trade everything under the sun, from stocks to options to commodities to bonds to everything you could possibly imagine. So, I come with someone who doesn't just have institutional market experience, but I was also not just a trader at the hedge fund, but I was also in charge of, or not in charge, but one of the lead instructors for the new hirees to teach them to become traders at the hedge fund. And so, my teaching experience is, well over, 15 years now in terms of trading, teaching the financial markets. And, you put those two together and just the experience, 50,000 hours behind the charts, seeing 3 different major market crashes. I've seen it all, and I've gotten to see some of the best traders in the world and how they trade and what they're all really looking at. So that's what I'm really going to be talking about today.
Yeah, I think it's so great that you bring in all of that into the mix because the markets are, there's a lot of things that impact the markets, and especially if you're trading options and the volatility, you have to be more in tune with it. So can you go ahead and share your screen, Chris?
Yeah, let's do that.
And get started. Guys, it's about to get started. You guys don't know what you're in for. Benzinga Option School launched today. And FYI, guys, yes, this does come with Benzinga Pro. Official start date, January 10th. Pre-enrollment starts right now.
All right, so let me know if you can see my SPY screen. Put a 1 in the chat if you can see that. I know there's a little bit of a delay. Nice, there we go, coming through. And I noticed in the chat, I'm seeing some members from Second Sky, so good to see you all. Attila and everybody. Gloria, everybody else, good to see you. And also Zinger Nation, good to see everybody here. So I have my webcam going. Do you want me to share that as well? I think it's sharing your webcam.
I believe, yeah. So you have to.
Oh, yeah, I'm good.
You're good?
Yeah, I got it here. Okay, we're
all
good.
Right.
All right, sweet. So I want to start off by first kind of explaining the foundation of my entire approach, because once you understand that and the principle and function of this approach, then it really explains how I trade options. And so, my approach is actually very straightforward. A lot of people ask the questions, do technicals lead fundamentals? Do fundamentals lead technicals? And the bottom line is really this, that it doesn't really matter whether you are a technical trader who gets their information from technical charts or, systems or indicators or whatever. Doesn't matter if you're a fundamental trader who looks at macro, who looks at earnings reports or anything. It doesn't matter whether you're a sentiment trader or a flow trader. The bottom line is all of us take those pieces of information and we all have to translate it into one common denominator, and that's order flow. And so if, you put an order in the market and it gets activated, it becomes actualized order flow. And if it doesn't, that's it. It's, it doesn't have an influence on the market. And the bottom line is also this, is that actualized order flow is the most proximate driver of price action. So all these movements that you see on the charts here, whether it's this kind of corrective congestion here or this volatile expansion here in the SPY, or this rip that happens over here, this impulsive move here, or a little bit of consolidation over the last 3 days that we've been calling out live, or this big selling off here, the bottom line is that's all driven by order flow. Whether that flow is technical, fundamental, sentiment, or flow based, those flows become a common denominator. They go through one channel and become actualized order flow. And that is the most proximate driver of price action. And so that is the kind of overall approach and foundation from which I look at the markets. And that's how I interpret the price action. That's the models that I use in the price action to kind of discern what the order flow behind the price action is. And more importantly for us as option traders is that option dealers and market makers are the most active players in the markets, especially today with option volumes hitting record highs. And so, you may think that option dealers and market makers aren't really active participants, but they're incredibly active. Every time you buy, let's say, 100 SPY calls, well, the option dealer and market maker behind that is short 100 SPY calls. And dealers and market makers do not want to have directional exposure. That's because they have a very good business model of being able to make money from transactional volume and spreads. So they don't want to have directional exposure up or down. And so if I buy 100 calls on the SPY, the dealer and market makers are short 100 calls on that. And so what are they going to do to hedge that exposure? So if I'm long 100 calls and they're short 100 calls, well, then they have risk to a particular direction. And then they're going to buy or sell stock or futures based upon that direction. And so it's important because those types of effects have an impact upon the market. They're the very reason why we have gamma squeezes, which you've all probably become familiar with over this last year or two. And so, with that being said, my approach to trading the markets is based upon order flow and understanding that order flow. And my job as an option trader is to understand where is the overall positioning in the market and what is the dealer's exposure and hedging exposure, because as they're unwinding their hedges or applying their hedges, then they are going to be adjusting their positions long or short in a stock or in an index. Does that make sense to everybody? Put a 1 in the chat if you understand what I'm talking about here. Mr. Goodman, good to see you. Mr. Torsten, good to see you. Very nice. And it looks like my YouTube froze a little bit, but it looks like everybody in the, yeah. Okay. All right, good. It looks like everybody's getting it. Very good. Sweet. All right, that's back online. Richard Judge says, blessings to you, man. Hope you've been well. A long time no see. Good to see you, Richard, as well. Okay, so with that being said, I want to kind of look at the order flows in the market that have had a major effect upon the S&P 500. And so we can kind of see a few different order flow regimes or gestalts over the last several sessions. What day is this here? This is all the way back to the 12th of November. So we can all look at this and see that this price action is different than this, not just directionally, but in terms of volatility, in terms of expression. If you are trading this to the long side, you're going to have different stop losses based on this more contracted range, what I call a corrective structure, which is where the order flow, because it's directionally up, is slightly imbalanced to the buy side, but there's still a presence of counter trend players. That's why it's not lifting off or taking off, with like just super high momentum. So this is very different than this, not just directionally, but look at how much more volatile and expansive this is. And then you can see that this right here is what I call an impulsive move, is very different than what we've had over here. And then you can see the last two sessions we've been selling off. Now, let's take each one of these and kind of start to explain them in terms of option flows. And then we can start to talk about how we would want to trade these differently via options so that you can have different tools to trade any environment. The goal of understanding options is that you can make money not just directionally. With stocks, you buy stocks, you want them to go up, you make money. If they go down, you lose money. It's very straightforward. It's just very binary. It goes up or down, you make money, you lose money. That's it. You can make some money on dividends, but that's not going to be your primary income. The bottom line is when you buy or sell stocks, you are a directional trader. And that's what you're making money. But when you trade options, you can make money whether it goes up, whether it goes down, whether the market goes nowhere. You can make money purely on volatility. You can make money if the volatility expands, like it did in this environment. And you can make money if the volatility contracts, like in this environment. So you can make money through volatility. You can make money through time. There's a lot of different ways that you can make money in options that you can't if you're just buying and selling stocks. And so let's take a look at these different environments. And you'll notice I have some red vertical lines, and we will get into this very shortly, what these dates are and why these matter. But in this environment, this is what I call a low volatility environment. So if you have a low volatility environment, for those of you that have some experience in options, would you rather put a 1 in the chat if you'd rather be long calls, or put a 2 in the chat if you'd rather be long a bull call spread? So which of those two do you think is the better approach during this environment? Parminder says 1, Misha says 1, Mel says 2. 2 and some 1s. Okay. So I got a majority of 2s and I got some 1s. And if you said 2, you are right. And the reason being is because long calls, while they make money directionally, have a very different risk profile and exposure to time and volatility that a bull call spread doesn't. And so when you have low volatility environments, you don't want to be looking at long calls or long puts if it's going to the downside, because you will lose money on theta decay, that's time decay in options, and you won't capture the volatility or really the gamma gains that you could get from that increase in volatility. And that's why buying a bull call spread is a better option in a low volatility environment when you're mild to medium bullish, than an environment, say here. An environment like this, you want to be long calls. It's a very different environment, and you have to understand the difference. And that has to do with understanding how options work and why the pricing of options and the functions of the Greeks and how pricing and the variables of Greeks affect options as a whole. If you don't understand that, then you might just buy calls in a low volatility environment, and you might buy a bull call spread in a high volatility environment and not capture as much alpha as you would by using the right strategy at the right time. So our job as option traders is to understand what's going on in the volatility of the environment. Our job as option traders is to understand what the positioning is, what's happening with the flows, what are the dealer impacts, the dealer hedging impacts, and then how we can choose the right strategy or the right tool for the right environment. So this environment that we see here, this low volatility environment, this is an environment that is very typical when the market is net long options. And it's important that people understand that, because when the market is net long options, that creates an environment called positive gamma. And positive gamma simply means that the market is net long options. And if you know anything about options and gamma, when you buy a call, you are long gamma. If you sell a call, you are short gamma. And positive gamma matters because of the fact that as a whole, when the overall market is in this positive gamma environment, you tend to get much more mean reversion, which is what you see here. You see a little mean reversion here, and you tend not to get high volatility moves. And that's important that you understand that, and when that is changing, because you could be using the wrong tool and the wrong strategy when the market transitions to positive and negative gamma. Very, very important. Now you can see right here, this vertical line, everything after this changes. The volatility expression changes drastically. It's way more volatile, much bigger swings up and down with an overall downward bias. Well, can anybody see what the difference between here and here was? Yes, Mr. Goodman. He's a student of mine, so he's kind of cheating.
No cheating, guys.
I see you, Mr. He's cheating. He's in the Zoom chat. He's cheating here. He's cheating because he knows he's heard me say this many, many times. So he's kind of taking advantage of that. Learn from the best. I appreciate that. So the monthly OpEx is oftentimes where you see the biggest amount of options kind of expiring and clearing the board. And that matters because if the market's been in a positive gamma environment on the 19th, and that's the expiry, look what happens right after that. The next day, volatility just changes out of nowhere. That is not out of nowhere. It's the options expiring and changing the structure of the flows, the open interest, and who's got the calls and the puts in the market and who doesn't. That changes. And when you clear a lot of those out, that changes the expression of the order flow in the environment. And you need to know that. If you look at let's go to the weekly chart real quick, and I'll just kind of show you an example. It's not a coincidence. If we look at the COVID crash, this week was the OpEx for February. Where does the market sell off the next week? This was the OpEx for March. Where does the market start to buy up after that OpEx? That's not a coincidence. And you can do this if you look throughout the last several years. Some of the biggest turning or inflection points in the market have been these OpExes. And that alone should communicate to you the power of options and order flows by understanding that. You understand that, that allows you to start understanding what is the more likely direction going forward. What is the more likely expression of the price action? Is it become more or less volatile? All of this matters. I see Rodrigo coming on board here. So yeah, please.
I'm just seeing all this education. When I started, there was nothing like this, Chris. And just watching over, and we'll go over the syllabus later, guys. But seeing all of the input, the insight that you put into calls really just makes me feel like a clown when I started, because it was just calls and puts and hoping for a rally. And, the information is not out there readily available. There's a lot of misinformation, a lot of YouTuber kids and stuff like that, TikTokers. And I think the voice of Chris Capre here is coming in here like with a bright light. Just, I wish this would have been something that I would have had when I started, like the support, the mentor, the teacher, that part, really.
Me too. When I first started off, also like you in the options world, I read a lot of those intro to option trading books. And to be honest, they were great for giving me a nice foundation of the mechanics and the dynamics of the option market and how, calls and puts work. And it was a new language for me coming from FX and stocks and commodities and everything. And so it's important. Those books have a role and those are important. But the thing about it is that if they define the options market as really just within that small container, that small package, then the curtain doesn't really get pulled back and traders don't get to look under the hood as to what's really driving this options market. And so they become more reactive and have limited tools to understand what's going on. And my job is to kind of pull back that curtain to kind of give traders a way to look under the hood and say, look, this is how the market functions underneath, inside. That was the great thing that I had the experience of as working as a broker, is I could see the market from the inside out. And that was very important to understand that. Just like there's a difference between someone who understands how a car engine works and someone who just kind of sees the performance of it from the outside. Those are two totally different perspectives. And so my job is to kind of be that mechanic to show you how the functioning, how the plumbing works and everything like that. So we can all understand like, okay, when this happens, this can or is more likely to create this situation than this situation. And it's important to understand that because there are going to be times where volatility is going to be flat and you're going to want to be directionally long or short, and it's just not going to be there. And so instead of spinning your wheels and wasting your time making trades that aren't matched to the environment, you can now find the right tool for the right environment. So that's really what I'm trying to do here.
Yeah, and the insight you have coming from the industry is great value here, because there's no way, like, a retail trader can watch all the videos they want on YouTube, but you can't compare that to trading side by side where you were. The other thing I think it's interesting is your experience in commodities. I don't remember like which fund is it, but it's one of the biggest ones in the world. The founder started as a commodities trader. There's so much influence in commodities with the actual stock market. And I think that's just more value, more addition here, because it's more than just, buying the call and buying the put. There's so much insight that you're putting into from what I'm seeing, Chris.
Yeah, it's important to understand that markets don't live in these like isolated ponds that never mix with each other. The markets are all really, interdependent and interpenetrating. So things that happen in the stock market influences the options market. Things that happen in the commodities market can influence the stock market. They all penetrate in one way or another because they're all really tied around money and liquidity. And so where money flows is where things tend to go, is where prices go. It's where levels go. It's where orders go. It's super important to understand that. So before we move on to the next thing, I want to just take a few questions here, and then we'll just kind of move on. So Bhavan Shah was saying, how do you define low volatility? Are you saying, and he's saying, is it an IV less than 50? Yes, but the thing about it is that you have to understand that there's a certain context to that. And we'll get into volatility in a little bit. So I want to come back to your question, Bhavan Shah. I want to address that when we start to get into volatility a little bit more. I'm not talking about IV right now yet, but we will get into IV and the VIX very particularly very soon. So yeah, let's see here. Do we have an actual class that we can attend? Yes, that starts January 10th. That's in the Benzinga Option School. And we'll be doing this live Monday through Friday just for Benzinga Option School members. Yes.
If any of you guys have questions about the school, it's going to start January 10th. This is the pre-enrollment period. So January 10th, the official start date. If you already have the Benzinga Trading School, you get $697. It's a different price. You'd have to call or email me. And if you're joining for the first time, it's $1297 with the 70% discount for the pre-enrollment cohort, which is starting today. It's for a full year. Classes are Monday to Friday. We'll go over the syllabus later. In the meantime, I do want to focus on the education here with Chris, guys. I'll just be posting the link there in the chat.
And one more question real quick was, or a couple more questions from Amir Farouk, who's saying, so after Friday, things will change. Yes, I actually just wrote an article about this on Benzinga. I'm pretty sure it's published live now, where I talk about the S&P 500. And yes, to summarize in a very short way, yes, we should expect volatility to have a massive expansion. There's a decent chance it could happen tomorrow because they have the FOMC. That's part of the reason why you saw this kind of contracted range. There's a couple of reasons why we saw the markets get really quiet over the last 3 sessions to end last week, is because traders were paring back positions ahead of the FOMC. And so that contracted volatility a bit. There's another aspect to that we'll get into when we start talking about VIX and volatility. But yes, that should be, there's a chance for volatility to change and expand massively tomorrow, depending on the FOMC works. But then this Friday is a December 17th OPEX. It's the monthly OPEX. And there's a lot of positions that are set to expire this Friday. And so when you take 30+% of the positions out of the market, that leaves the market in a very different state than with that 30% of positions in there. And so what have we been seeing over the last few days? We've been seeing a sell-off the last few days. And what have we seen on the option flows? We've seen an increase in long puts. And a huge majority of them have been short dated, meaning they're set to expire this Friday. So what are traders doing ahead of the Fed? They're paring back positions as they get into this area. They start to have a little bit of worry that something might go bad. So they buy short dated protection, long puts. And so then the market starts to sell off during the session. And so, or the last 2 sessions, that's what's been happening. Right now there's prior to today, there was roughly 12.9 million puts in the SPYs, and there was only roughly 6.5 million calls. So 2 out of every 3 options prior to today were puts. And so we saw that's a huge increase in put volume. And so that's what's been happening. We've been seeing a lot of short dated, long put buying in the S&P 500. So that's why you've been kind of seeing these flows and these changes on the day. Let's see. Is there anything else I want to say on that? And the other thing about it is, so he's saying OPEX, is that similar to witching? So OPEX just means option expiry. I use OPEX for the monthly. The witching is the quad witching because it's the end of a quarter. You have 3 separate expiries all happening around the same day. So that's what the quad witching means, or 4 separate expiries all happening around the same day. So it's super important that we understand that. So with that being said, that's kind of what's been going on. Any other sessions be recorded? I'll let Rodrigo answer his questions in a little bit. Okay, so with that being said, we've covered kind of different environments here. We see the volatility change here. I want to go over this here, and I'm going to highlight this particular area these last few days where the market just kind of hit a bottom and then it ripped for 2 days. And then I want to go over to VIX. So these days are the 6th and the 7th. And if you are trading options, you have to be, you should be watching SPYs, but you also have to be watching VIX. Super, super important. So let's take a look at those days, which is the 6th and the 7th of December. And that would be this session here. And this is where the S&P 500, this is the first day. So the blue is the pre-market, and this is the white is the regular session. And these are the 2 days that the S&P 500 started to rally. Now, what was happening at VIX at this time? So VIX, you kind of think of, a lot of people think of the VIX as in a very simplistic way as a fear index, but you also have to look at it as a level of uncertainty. You have to look at it as a measure of uncertainty. If VIX is low, traders have a fair level of certainty or conviction about the future of the markets. But if VIX is high, you have to look at it as a fair amount of uncertainty. And traders tend to buy more put protection, long puts, when they feel more uncertain about the markets. If they feel the markets are just going to keep on trucking along to the upside, they're not going to buy put protection to the downside. So VIX had been really rallying for quite a long time. We had the big gap on this day, and then the volatility expansion really increased in VIX. Now, as VIX started to get to 30, some kind of interesting, what I would call dynamics started to enter the markets. First off, historically, when VIX gets above 30, and I've marked this level, when VIX gets above 30, usually VIX gets crushed. And what that generally means is that when VIX gets crushed, the S&P 500 rallies. So you look at them as kind of reflexive, inverted versions of each other. When VIX goes up, SPY tends to go down. When VIX goes down, SPYs tends to go up. Now, if you look at this 30 line right here, most of the times, other than COVID, over the last several years, most of the times when we've gotten above 30, shortly after, VIX sold off. VIX spikes in the week above 30, sells off. Spikes above 30, sells off. Spikes above 30, sells off. So historically, probability-wise, the 20, 30-day averages for the S&P 500, when VIX gets to 30, usually is very favorable. What it also means is this, is that if VIX is spiking and there's that increased uncertainty in the markets, that means there's an increased demand for protection, downside protection. That means traders are buying puts. And the thing about it is that with options, as the prices of these things rise, particularly if VIX starts to get really rich, what happens to implied volatility as VIX goes up? So this is a question for you all in the chat and in the live YouTube here. What is the more common reaction that when VIX starts to really spike, what happens to implied volatility? Yes, Kaizen got it. Increases. Yes, increases. Okay. So when VIX increases, implied volatility also increases. But the thing about it is that as implied volatility increases, what happens to the cost of those options? So let's say I'm long VIX. Let's say I own calls on VIX and implied volatility goes up. Yes, price goes up on those as well. And then the price just keeps climbing and climbing and climbing. But if it keeps doing that, then what's that eventually going to lead to? This is where you got to start thinking about kind of like a few steps ahead in options of if price starts to get really expensive, what are you looking to do? What happens to those options as they get more and more expensive? Yes. 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 They start to get more and more expensive. So think about it like this. Let's say you all recently bought a house for $500,000 and you felt that the house was a good price for $500,000. Now, what happens if you were faced with buying the same house and set the real estate agent was like, you know what? We're not selling it for $500,000. We'll sell it for $550,000. You might think, okay, it's still a good deal. I'm still going to make money in this a long period of time. I still plan on holding this. I think it's a good value. So you're like, okay, I'll pay $550,000 for it. But what happens if the next day the broker's like, sorry, we can't sell it to you for $550,000. It's now $600,000, or it's $650,000, or it's $750,000, or it's $1 million. Eventually, those prices will get rich, and they'll be too rich for a lot of buyers. And then what happens is, if you don't have people continually getting long calls on VIX and VIX is getting too rich, it needs more and more capital to continue rising higher. And if it can't attract that capital, eventually nobody will be buying calls anymore on VIX. VIX collapses. And so what happens on the 6th? VIX collapses big time. Let's do an overlay of the S&P 500. And look what happens. As VIX gets super rich and then sells off, this is what happens to SPY. So when I look at, and this gold line here is the S&P 500. So when I look at really this kind of sell off in VIX and this rip in SPY, I look at that as a reflexive movement. And it's important that we understand that, because part of the reason why the S&P 500 was able to rise was because people were selling puts, or they were getting rid of their VIX, their long calls on VIX. And so as they were getting rid of their long calls of VIX, VIX sells off. That creates what we call a Vanna fuel or a rally for the S&P 500. It creates a tailwind because the people that were those long puts on the S&P 500, VIX goes down. They're like, meh, I don't need to hold these long puts anymore. I'm going to close them out. That reduces the downward pressure on the markets, creates an S&P 500 rally. So after that rally was over, the market consolidated. And what was I telling my live members over those few days? I said, look, the market's done rallying and it's probably going to consolidate because we're not seeing a buildup of call positions. We're not seeing a buildup of long calls. So the fuel for this rally is over. We now need to start switching to neutral trading strategies. This is why it's important that you understand the flows in the market. You understand the pricing of these options. You understand how VIX and SPY work with each other. You understand how things, when they get rich, they make it harder and harder for something to continue to gain. And when you start to understand this, then it allows you to kind of dance with the market as it changes pace, as it takes different steps. That's what you have to be doing. If you can read the flows in the market, then you can apply these different strategies. And that's really the goal of what we're doing in the Benzinga Option School, is to try and teach you skills, methodologies, and strategies to read this so you can adjust your strategies on a day-by-day basis to whatever the market and the flows are communicating for that day.
Impressive, Chris. We're getting so many questions about the option school. I'm just going to go ahead and share the syllabus here, Chris. I'll just use the screen really quick. One second, guys. Okay, so can you see that, Chris?
Yes, I do.
Okay, guys, so I'm showing you guys the syllabus, okay? Class 1, Introduction to Options. Class 2, Understanding Option Greeks. 3, Understanding Volatility in Options. 4, Single Leg Option Strategies. 2-leg option strategies. 3 and 4-leg option strategies. Combining option strategies with price action, market gamma, and how to build your own option strategies. So these are the total 8 chapters that you'll be going over with Chris. This is the schedule. Monday starting at 10 a.m. All of these are Eastern times. You start at 10 a.m., 10 to 10:45 lecture, 10:45 to 12 lesson Q&A and current market examples. You have a break. You meet again from 3 to 4, and you have a full review of lesson review and open market discussion with Chris. And then Friday from 1 to 2, you have a full class review of the week, guys. Everything with Chris. You're going to have also Benzinga Pro included. That is something that I am showing you in the screen right now. You know, if you want to, I mean, you guys are already familiar with Benzinga Pro. You get this included with the Benzinga Option School, okay, for the full year. If you have some time, we're going to post the link in the checkout, guys. This is how it looks. You're going to see the discount. Full price is $3,600, discount $1,297. If you have Benzinga Trading School, the price is $697. You'd have to contact me. I will manually do that for you. But this is the options school with Chris Capre. That's the syllabus. And I mean, obviously, Chris Capre, he's been doing this for a while, but you guys are very lucky to have that. So I don't think there's any other questions on that for now. You will renew at the same discount. So even if the price goes back up, you will lock in that rate for the option school. So I think I'm just going to be posting the link, guys. I think we're good with questions now, Chris, if you want to take the screen.
Yes. So let's see here. Share screen. Great. And back to, let me know when you can see my charts. Put a 1 in the chat if you can see my charts again. Should be a mix of the VIX and the S&P 500. Sweet. Thank you, guys. Appreciate that. Just want to get to a few questions here that some people had. Is this class different from the one that used to start at 7 a.m. Eastern? Yes, that's the Benzinga Trading School. This is the Benzinga Option School. Prashant has a question. Is VIX a lead indicator or lags the market? I don't look at it as leading or lagging. I look at it as something that is a reflexive indicator of the market. If you really start to understand how the options market works, a lot of the things that happen are reflexive. For example, if I buy 100 calls on the S&P 500, the dealer market maker reflexively is selling 100 calls. And so if they're selling 100 calls, then they have exposure to which direction, up or down. So if the dealer is short 100 calls, where is their exposure, up or down? Let's see here, rolling down. And Sandy had a question about Fed, and we'll get to up. Yes, they have upside exposure. So what are they going to do? They're going to get long shares or futures. If it's a stock, they'll get long shares. If it's an index, they'll get long futures. So there's a certain reflexivity about that. And so you can't look at it as leading or lagging. You got to look at it as interdependent. They're interdependent. They're affecting each other in real time. So super important that we understand that. Sandy had the question in the Q&A. Does the Fed affect direction? The Fed, I wouldn't say they directly affect direction. They create policy, and then traders interpret that. And then that could create a directional change in the markets. So it's more of they do it by a reactivity, but they're not directly changing the direction. Now they are, of course, they have all these Fed asset purchases. That obviously has an impact because those are flows. But yes, they do, but more of how the market interprets it. So super important. Lisa again saying the school is just 1 week in January. No, the school is for 1 year. It starts on January 10th. So hopefully that answers your question there.
Hey, Chris, really quick.
Yeah.
This is how we do the welcome for all the new family members. We have a new family member, BB Levins, recently joining here, the Benzinga Options Trading School. Welcome to the family,
aboard.
my friend. Welcome, guys.
Welcome aboard. Good to have you on board. A couple more questions here. Is there a chat group in the options school? Yes, there is. And I'm really excited to dive into that because, I don't just share trade ideas. I help people construct trade ideas so that they can do it themselves. My job as an instructor it isn't just to fish for you. It's to show you, look, here's how you can find trade opportunities in the markets. And I've been doing this with my students at Second Skies for a long time. And some of them have developed into really fine option traders. Some of them are attending this right now. And so, that's my goal, is to teach you how to not only follow me, but to understand this and to make your own decisions and find a strategy that works for you. Because the bottom line is you always have to take whatever you learn and then tailor it to where your skills are best, where your mindset works best. For some people, that could be day trading options, and we'll talk about strategies to do that. For some people, that could be swing trading, weeklies, maybe monthly expiries. For some people, that could be quarterlies or leaps. We all have to find what's best for us. And so my job is just to take your knowledge and skill set deeper and give you tools so that you feel prepared to handle any environment out there. How much experience do I need to take the class? I don't think you really need any experience because we do start at the ground level in the first lesson. And again, so the way the course works is the first week is lessons 1 through 4. The second week is lessons 5 through 8. But then after that, we repeat. So on week 3, we come back to the lessons again. So we'll continue going through them. But then as the school members develop and learn the material and get deeper and stronger with it, then we can start adding more nuances to the material. So the material, while it's the same, will evolve over time. And that's my goal, is that by the end of the year, even though we're going through the lessons, we can teach on a much more developed level because the school as a whole has grown. So yes, you don't need much experience because you start at the ground level.
The way I look at it, Chris, it's like just like taking any course in college. Like, you attend the first class, and that doesn't mean you took the whole class. Obviously it gets more complex as you go because we want to make sure that no trader gets left behind. That's our policy.
Which you think is better, EMA or SMA? Depends on what your application is, especially for options trading. I prefer to use EMAs because they're they're going to be more sensitive to the recent price action. They're not going to smooth everything out. I don't consider all price action equal in the sense of, what happened 20 days ago is just as important as what happened yesterday. And by being more sensitive through an EMA and looking at the more recent price action, then it's taking in changes in volatility recently and how that kind of impacts it over time. If calls are not going in the direction I was thinking, should I sell the call or buy puts to cover? That depends. There's no way to answer that right now, Mark, because I don't know the chart you're looking at. I don't know what position you're looking at. I don't know what your original intention is, but we will teach you how to understand what your position is and how to adjust if needs be. Yes, we will get into that. It's much easier to see trends looking backward. Can you speak to how you study during a live trading day? It's totally true, Rich, but there's a couple things to understand. First off, with my live members and not only in the Benzinga Option School, which will be starting, but I've been teaching live with my members for Second Skies for a long time now. And every single day I do live analysis. I'm looking at the same right edge of the chart as you are, as with my members. And I will literally tell them every single day, here's what I think the max move is on the S&P 500, up or down. Here's my key levels. Here's what I think it's going to be a volatile, or it's not going to be volatile. We're going to be range bound. We should have bullish bias on the day. We're in positive and negative gamma. So sure, it's always easier to look back, but the bottom line is we have to make decisions at the same right edge of the chart. And I do this with my members all the time. And my members can pretty much tell you right now in the live chat or in Zoom that I'm pretty on the ball. Like 80% of the days I'm calling the direction before it happens, pretty much how it works out. Like I'm calling the levels, I'm calling the level of volatility, I'm calling the kind of max moves on the day. Like I'm doing that every single day. And I will be doing that for the Benzinga Option School as well. So yes, that's true, but that's not my job. I can look at the past section to kind of get an idea what's going on in the future, but the bottom line is I'm faced with the same right edge of the chart. And so, yeah, so hopefully I answer your question. Can you speak to how you studied during a live trading day? So the second part of your question is very good. So the most important thing that I look at, as I said before in the beginning, is I want to understand what's going on with the order flow in the market. And if I can understand the positioning, if I can understand where the open interest is most concentrated, where is the gamma in the market strongest? Where is potential hedging exposure from the dealers going to start coming in? Because there's going to be times where the dealers will trade with the market. That means if the market's going up, they're buying as it goes up. But there's also going to be times where the dealers are trading against the market. So as the market rises, they're going to start selling. And as the market dips, they're going to start buying. That's trading into the market, not with the market. And as long as I can understand and read those ahead of time, then I can get an idea as to what is the more likely expression for the day. And as you continue doing this, and as I will teach you how to do this, eventually you'll just get better and better. Like I'm sure my live tribe members in here will tell you, yes, Chris is usually accurate in predicting the day's movements 80% of the time. Like it's pretty consistent. So, and I have years and years to back this all up. I see Rodrigo's back, so please jump on.
Let's say that somebody's in a pickle, right? They took a bad trade, they're under the water. Typically what people do is that they'll go to Reddit or TikTok or any of these places because they might be a little bit maybe they don't want to share their story with people that know them, they just want, I don't know. But definitely I'd suggest that like doing this, being able to, you helping them, right? That's something that like if somebody has an issue with a trade, you'd be like their mentor, their guide for damage control, basically, if they're in a pickle with a trade.
Yes. And I do this every single day with my current members, and I'll be doing this with the Benzinga Option School members, which is, look, we're all here learning. Tom Brady, who's like the best football quarterback of all time, probably, he's still learning. If he's the best of the best and he's still learning, I'm still learning, you're still learning. We're all still learning. There is no end to the learning. There's no end to the depth that we can get to in terms of understanding options. There is no end point. And as we learn and as we grow, we're going to make mistakes. And my job as a mentor is to give this unbiased view of the market that will help you see what you did right, what you probably could improve upon, and what you need to adjust going forward, whether it's this trade or other trades. And so in Benzinga Option School, we have a lesson every single day, but we're going to have a live Q&A that's going to be showing you market examples and then talking about the market live in real time and saying like, look, this is where I think the market's going. This is where it's that. We will also have a time for Q&A where traders in the school can share, hey, I'm in this trade, like Rodrigo said, and hey, I'm in a bad spot. I did this. I didn't do this. What's the best way to adjust to this? And sometimes that will be, hedging your position through options. Sometimes that will be through adjusting your deltas. Sometimes that will be through just exiting the position completely. And just like, like when you have your friends that are having problems in relationships and they come to you, it's very easy for you to give unbiased opinions because it's not affecting you personally. You just have this kind of, neutral view of it, and you're able to see things clear because you're not emotionally involved. Well, me as a member, I'm not emotionally involved in your trade. I'm not financially involved. So then I can use my 21 years experience to say, hey, look, based on this, based upon this, based upon this, I would do X, Y, or Z. And then give you options for how you can adjust to that going forward. That's a great, great question, Rodrigo. Super, super important. So yeah, I do want to get to the second. I've already covered the second part of Rich's question, so I got to that. Is this class for beginners who know nothing about options? Yes, we have a whole set of intro lessons to it, and we'll keep repeating them every 2 weeks so that you have the chance to go through the intro stuff over and over again. We start from the ground and we slowly work our way up with each class. And so, yes, absolutely. My job as a mentor is to take all the learning that I've had, take your experience and condense it and accelerate your learning process, because I myself have gone through the process for years of learning options. And now that I have all this experience, I can look back and be like, wow, if I was on day one, what could I do to accelerate this process? That's my job today. And so, yes, absolutely. Cliff is saying confused. Curriculum shows 1 week schedule, but you say the school is for a year. So yes, the way that works is the curriculum is not 1 week. It's 2 weeks of lessons. It's 8 lessons, 1 lesson per day. But what we do is we go through a rotating 2-week cycle. In week 1, we go through lessons 1 through 4, 1 each day. Lesson 5 is open office hours, open Q&A, market analysis, live examples. The second week, we go through lessons 5 through 8. And then after we've done that, then we repeat it again on week 3. So we start with lessons 1 through 4 again, and we keep repeating that cycle throughout the year. So you have access to the mentorship for the year. You have access to the Benzinga Pro for the year. You have access to me for the year, and you have access to the lessons for the year. And the lessons will evolve as time goes on. As the members get stronger and more nuanced, we will evolve the lessons over time for sure. Okay, a couple more questions. What chat is Chris reading from? I'm reading from Zoom and the YouTube live at the same time. Let's see. Is there an advanced option course? No, but as I created this course, I was thinking to myself, like, man, there is so much more. There's like, this can take you from 0 to profitability without a doubt. If you really digest this material and turn it into skills, by the end of this course, you should be profitable. You should be consistently profitable, assuming you're doing all the other things right. But as I said, options, there is no level to the depth of it. And, hopefully in the future, as this course becomes successful, we can then create another layer of an advanced option course on top of that. We're going to get into some pretty advanced stuff. Most people are not talking about market gamma. Like I heard one person in the chat saying, oh, this is taught for free on Tasty Trade. And I'm going to call BS on that, because I know Tasty Trade and they're almost never talking about market gamma. They're almost never talking about, dealer market making hedging impacts. They're almost never talking about, I've never heard them talk about, this is the absolute best price action for this strategy. And this is the best one for this strategy, or this one for this strategy. And that's the big problem with options education today, is that you can read 100 books on options and they will tell you again and again and again, and you'll see the words repeat themselves. In this strategy, you should be using this when the market is mildly bullish. In this strategy, you should be using this when the market is heavily bullish. Well, what does that mean? What does that look like in the charts? I will be taking my 21 years experience and giving you very concrete structures and patterns and gestalts of what that looks like in the charts and when is the best time to be using that. Nobody is talking about that. There's nobody in the YouTube world out there today or in the courses or anything that's saying, hey, in this strategy is best match up with this price action environment, and this is what it should look like on your charts. They'll just say, oh, mildly bullish. Oh, you're heavily bullish. That doesn't do any good. We have to clarify what that means. We have to show you on the charts what that looks like. And because I have 21 years experience of trading price action order flow, I do clarify exactly what that looks like. So I'm calling BS on that comment there, whoever said that. Sorry to call you out, but I have to mention that. So Um, okay, a couple more questions, and I want to move up. How long options be structured when market direction is typical? How can long options be structured when market direction is typically shorter than long options? Okay. When you talk about long options, are you talking like long calls, long puts? Or are you talking long dated options? Those are two different questions. I think what you're saying is, how can I do longer term options when the direction is changing constantly, week by week, month by month basis? Is that the question you're asking there, Sandy? Put a yes in the chat if that's correct, and put a no in the chat if it's not. Yes. Okay. Thank you for that. Okay. So the longer the options are, the longer dated expiry you have, obviously the more environments, the more structures, the more order flow environments you're going to be exposed to. So really what you're talking about is a question of scale. If you are going to be doing leap options and you're going to be holding an option for like 1 year out, 2 years out, 3 years out, you are not going to be scale. You don't want to look at a scale where you're looking at the 5-minute chart, because the structure and environments on a 5-minute chart are going to change maybe several times a day. So what you're really talking about is, hey, I'm going to be wanting to do something that's going to go through lots of changes, but my job is to get the overall direction. And so we actually have an entire lesson on how to do long-term options and make adjustments for these changing environments. So we will cover that in the course itself. This is a great question. Approved Nate, does one need to complete the trading school before the option school? No, you do not. You do not. Is reading candlesticks part of this? Yes and no. And I say yes and no because when I read charts, I do it through candlesticks, but I am not going to require you to understand candlestick patterns because I don't believe in candlestick patterns. I don't believe they're useful skills. Statistically, most candlestick patterns fail. Thomas Bukowski had demonstrated this in his book. If you look at the majority of candlestick patterns he presented, most of them fail. And I don't really find them to be good skills for a price action trader to learn. I find it better to look for the overall order flow and gestalt. And I have price action methods that I will be teaching in the course. So yes, hopefully answers your question. Let's see here. Is there a limit to the number of contracts that I can trade assuming unlimited funds? No, but there is a limit to what will be filled by the dealers and market makers. So there is that. How many live classes does this include? It includes a live class 2 times a day, Monday through Thursday, 1 class a day on Fridays for an entire year. And Rodrigo's saying some people were asking, some people had asked about my performance. We posted our live performance. I did about a 72% return in 2020, all verified. You can see the P&L curve on my website, posted a video to it and everything. It's on my YouTube channel as well. Talks about number of trades. We did about 500 trades last year, accuracy right around 63%, risk and all that stuff. So yeah. Okay. Any other questions I want to address here for a second? Okay. I feel like I've gotten the most of that. Cool. This is the education retail newbies need. It peels back the onion, shows the layers, options, strategies. And I know it's so important. Don't get me wrong. There's some really good intra education options market out there, but that's a vehicle that's only going to get you so far. And this, vehicle is designed to get you a higher top speed. How much pressure does Tesla put on the VIX? Not that much at all. You can't really think about that at all. Because Tesla is one stock. Don't get me wrong. It's a large holding in the S&P 500, and it's more and more a part of people's portfolios. But a single stock name like Tesla could be getting crushed, and VIX might go nowhere on the day because VIX is much more reflective of the overall market, not single stocks per se. Can we look at tired of all this red in the S&P 500? We might get a lift tomorrow. It really depends on the FOMC. if they're hawkish, inflation concerns, they're going to cut back on they're going to accelerate the reduction in tapering. That might be bearish for the S&P 500. But instead of being tired about all the red days in the S&P 500, maybe learn to trade with that. Maybe learn to hedge your portfolio against that. Maybe you learn to use options so that maybe your long stock portfolio is losing money, but your long options or your short options can be making money on that. That's what we want to use options for. Is, generally if you're trading stocks, you generally have a long only portfolio, or most of your portfolio is long only. And so that's great when the market's going up, but when the market's going down, you're exposed. And so this is one of the greatest things about options, is that you can make money with a long only portfolio on stocks while the market is going down. You could sell calls, you can get long puts, you can get long, bear put spreads. You can get, you can do broken wing butterflies, you can do calendar spreads. There's so many different things you can do that you can't do if you're just buying and selling stocks. So yeah. Catchy handle. If you were able to shift the time frame just a few seconds, the candlestick pattern would be completely different. That's true. That's true. Is this subscription for 1 year? Yes. So if it is, then do we get trade signals every day in chat? So I'm not giving like trade signals, but I am covering market direction, and I'm explaining trades that I'm taking, or I'm in, or I am looking to trade. And I will be going over that, but we're not going to be like long, 470 S&P 500 calls, for such and such expiry. I will make a lot of those suggestions, but I'm not giving like entry, stop loss, take profit kind of things. That's not part of the service. If it was, I would be charging like $100,000 a year for that per person. Are you a pure technical trader, or do you use fundamentals as well? I am an order flow trader. And so, yes, I pay attention to fundamentals. I pay attention to all the aspects of information, but fundamentals is just a form of information that influences buying decisions, just as technicals is a form of information that influences buying decisions. And there's no way to know if there's one piece of information or 10 pieces of information that's directing the order flow. So I say, don't bother, learn to read the order flow. If I can't discern what is the 100% technical reason for why the market's going up or down, and if I can't discern the 100% accurately what the fundamental reason is for why the market's going up or down, then what can I do is I can look at the order flow and say, hey, we have a heavy imbalance to the buy side, or we have a heavy imbalance to the sell side, or the market is seriously long puts right now, or the market is seriously short puts right now. Well, I can look at that and get an idea of what the market is more likely to do. So instead of being a technical trader or fundamental trader, I'm a flow-based trader. So hopefully I answered your question. Let me answer a few more questions here from YouTube. I did buy some 470 calls for cheap on the dip. So let me give you, this is going to be my feedback as a trader. I have told my students at Second Skies, and if I was teaching the Benzinga school right now, I would be telling them, cautious on buying long exposure, buying long options right now. Why is that? Granted, the calls could be cheap. S&P 500 is sold off, as we know. So S&P 500 is sold off over these few days. But if you're long calls, what else are you long? There's two other things you're long as well, or I should say exposed to. So if you are long calls, what are your other exposures besides direction? From an options perspective, who knows the answer to this one? Put it in the chat. And my article about Benzinga just came out 3 minutes ago. So, okay. You're exposed to theta. Yes, very good. That's one thing. Also volatility. So let's say you're long 470 calls. Well, if the market goes up, that's going to increase the price of the calls. But what is another variable that affects the value of those calls? Implied volatility. If implied volatility comes down, then that is going to change the value of those calls differently than if implied volatility stays the same. So you have to understand that as an option trader. Who was that? Mr. Michael Lee. So super, super important. The other thing is that if you're long calls, you're also long theta, which means you're exposed to theta decay. So every single day the market closes, your calls lose money. And if I really believe that 470, the market is going to gain after the FOMC tomorrow, wouldn't I be better buying those calls tomorrow than today instead of just eating the theta decay? Probably. So this is the kind of feedback that you would be getting from me every single day. When you're long options, you're always long volatility. You're long, that means you're long gamma, you're long volatility. You're also exposed to theta decay because you're buying that contract. So every single day it's very much like if I buy car insurance, I am paying for car insurance over time. As the time goes by, maybe I make my payment, but if I don't have an insurance claim, I lost the value of that contract that I paid over time. So anytime you're long an option, you are exposed to theta decay. Your option is decaying every single day. Super important. And volatility as well. If IV comes down, that option becomes less valuable. Okay. All right. A couple more questions, and then we're going to wrap. We're going to move on. Let's see. I've covered that. How much experience do I need to take the class? I don't really think you need any experience because we do start from the ground up. We covered the Tesla VIX question. Can you quickly explain market gamma? Yes, give me a second here. I'll just give you a brief explanation of it. We answered that question. Rodrigo can answer that question. What is my YouTube channel? Second Skies Trading. Do you teach proper size management? Yes, it's not a focus of the school because the school is to talk about options. You all have to decide option positioning, but I will give feedback on option positioning and talk about size. The thing about position sizing is the least sexy. It's one of the most important things. I always say, if you are really an experienced trader, your first focus is always risk, and then you focus on profits. Why do we focus on managing risk, or why are we risk managers first? Because if you don't manage risk, then you don't keep your profits. It's very, very simple. If you do not manage risk, you do not keep your profits. You will lose your profits over time. So risk of ruin, yes, that's my guiding principle, is really the risk of ruin. And so we don't have a specific lesson on it because the course is about options, but yes, I will be happy to talk about that. How can you tell what the current flow is? That's actually not that hard. Let me open up here we go. So can you guys see this screen here on the Qs and the option chain? Put a 1 in the chat if you can. Good. You can't see it, Cypher? Okay, Cypher can. Okay, so I'm giving you the shortened version of the option chain, but what do we see right here? Open interest for the December 17th expiry. What do we see here? Volume for the December 17th expiry. So what is volume? Volume is the number of transactions that were activated on the day. That doesn't mean when they're opening or closing. It just means the total volume of transactions that were executed in the day. Open interest is the level of contracts that are not settled at the particular strikes. Now, this is a shortened option chain, just the top 14 strikes. This is the full option chain. And you can see there's a lot of strikes. And so that's a lot of data to take in. Now, I have proprietary programs that help me to collate that data and then interpret it a little bit easier. But I am working with Benzinga to eventually create proprietary tools in Benzinga so that it collates all this data and helps you translate it. So you don't have to look through like 100+ strikes to get an idea of what's going on with the flow. This gives me a rough idea of what's going on with the flow, but you need to be doing more calculations and more analysis to get an idea of gamma hedging requirements, notional gamma, dealer hedging impacts, where are the biggest positions over all the expiries, et cetera. There's more involved in that. But yes, you can see flows this way as well. Is there a way to chart volume and open interest? I'm working on it. I'm working on it. Yes, there is. I'm working on it. That's one of my goals with Benzinga. Let's see, there's a lot of ones there. the account size needed to be Joe, are you asking Joe R. Joseph Brown, are you asking what account size you need to be profitable, or are you asking what is the minimum account size needed to trade options? Because those are two different questions. So let me know. Okay, I'll wait for Joe to kind of type that in here. When will this option flow with Benzinga be available? I don't know. We haven't started yet. We're just building the school right now, but eventually we'll, our goal is to get those tools available in the near future. When it's ready, we'll announce it. Richard says, show us an example of a trade with your methodology. Sure. So let me move this aside for now. Okay. So I can actually share with you a trade that I got those questions there. So two trades I made last week, very straightforward. I posted these live for my members in Second Skies, and I will be sharing the same kind of analysis and trade ideas and things like that. Not trade signals, but trade ideas with the Benzinga Option School members. So after this VIX crush, not just VIX crush, but Vanna-induced rally, the market shot for 3 days. So if the market goes from high volatility impulsive to corrective, what kind of option strategies do we want to be doing? Do we want to be doing directional or non-directional strategies? Put a non-directional. Okay, so good. So now we have an idea. We can eliminate long calls. We can eliminate long puts. We can eliminate directional strategies. Okay, so who knows of a few examples of some non-directional strategies, or what we could call neutral strategies? So just list it in the chat or in there in the YouTube. YouTube's, I know, is a little bit of a delay, but I'm trying to keep up with you. Butterflies, very good. Yes, you can get long call butterflies. You can get long put butterflies. Bull call spreads, I don't recommend it because bull call spreads make money if the market goes up. If the market's not going up, they don't make money. You can do calendars. Yes, you can, but calendars are generally, I generally like to do calendar spreads under slightly different environments. So butterflies are good. Iron condor is good. Yes, Mr. Mark Augustine, iron condors, iron butterflies as well. The strategy that I chose was a straddle. So I got short a straddle. I sold a straddle. So I don't know if it was on the 8th. I think it was on the 8th or the 9th. I think it was on the 8th. I sold a straddle, 0 days to expiration. And that was very straightforward. Once we knew that the market was going to do this, sold a straddle. Selling a straddle is very straightforward. You sell a call and a put at the exact same strike. I think I sold mine at 469, and the premium on each of those calls and puts that I sold creates my break-even barriers. So let's say I sold and let's zoom into this to make this a little bit more clear. There we go. Okay. So I sold the 469s, 0 days to expiration. Okay. The premium I got on that, if I remember correctly, and maybe my Second Skies members can type in, but it was roughly, I think I got like a little over $2 premium. Justin Goodman says 2. Okay. So it's like right around $2. So what that basically means is if I'm selling the 469 calls and puts, well then, and I get a $2 premium, then basically my break even to the upside is 471. And my break even to the downside is 467. And so what happened on the day? Hit my 467 break even, bounced, closed just a little bit above my break even, got to keep the full premium. Very straightforward. So my strategies are based upon price action, order flow, volatility, gamma environments, the market gamma in the environment. And then I look at all that and I say, what is the best strategy for this environment? So, it's kind of like being a weatherman. If it's really cold outside, I might wear a thick jacket with kind of like multiple layers, but maybe it's not so cold, but it's windy. So I might use a windbreaker that can kind of break that wind down. I don't need as many layers. It's really what you're doing as an options trader is you are understanding the environment. You are understanding the volatility. You're understanding the order flow, the price action. You are understanding market gamma, and you're understanding the reflexivity of that. And when you can take that picture and turn it into kind of like a clear, understanding of what's going on in the order flow in the market, then you can choose the right tools for that. Butterflies would have been fine. Long put butterflies, long call butterflies would have been fine. Iron condors would have been fine, less premium. Iron butterflies would have been fine. I sold a straddle because that one allowed me to kind of, in that case, capture the most premium, so to say. Do I sell naked calls? Almost never. Almost never. Almost never. I'm not going to say never because have I done it before? Sure. But like in 2021, I did it once. I almost never do it. And I do not recommend beginning or even intermediate traders sell naked calls. It takes a really high level of skill to do that and not get burned. And that's just not something I recommend to anybody in their first 3 years of trading options. And a lot of capital, for sure. Do I have a service where I recommend options? I will be recommending options and going over trade ideas. I'm not giving trade signals, but I will be going over trade ideas in the Benzinga options tool because we'll have a market analysis where I'll be like, look, this is the environment. This is the gamma. This is what's going on. With that being said, this is the best options to trade. This is what I'm looking at. Yeah, Melgod, short straddle. Needs to be level 5. I think you're talking level 5. I don't know. My broker just gives me the highest level of recommendations that I can get. So yeah, they don't give me any restrictions on my options. Do you also teach how to screen for securities for trading options, or is it always SPY indices? Yeah, I trade everything across the board. Single stocks. I look at all the meta indices every single day. I trade everything across the board. In terms of screening, I'm not going to teach you necessarily like, oh, use this filter to pull up all these options in Thinkorswim. That's a different, while I think that's an interesting skill, I think it's far better to use the Benzinga movers on the day. And then from there, look at each one and start to isolate the best trade ideas. Kylo says, how much do you make per month trading options? It's not your business. My financials are not your business. So yeah, it's just not your business. I hate to do that. I'm not someone who like brags about my income, but I own a business. I can get sued. I've gotten sued before. And if people knew how much money I made, do you think they're going to sue me for more money? You better believe it. So that's not your business. So I apologize for not answering that. I can tell you this, my standard base contracts that I trade is a base 10 contracts per contract or per position I'm taking. That's the base, but sometimes I'll trade 20, 30 or more contracts, but that's the base number of contracts that I trade. So I can tell you that. It's cool. I appreciate it. Which platform do you feel is best to trade options? This is a great question. I use Thinkorswim. I really like their option chain and I like their analytics tab. I think it's some of the best out there. Tastyworks does have some, Tastyworks has some nice intuitive tools, but then there's certain tools that they don't have that Thinkorswim does have. And so I've just found Thinkorswim to be, for me personally, my answer to that though is find the platform that is easiest for you to use, that is the most intuitive for you to use, that has the best user experience, and then use that. Yeah, it's a great question. Long means buying as opposed to selling short. Yes, he was answering somebody else. So when yes, long call, Gloria is saying long call, you have bought the call, correct. You have paid the premium for buying the call, correct. Do you need large capital for a straddle? Straddle is definitely a margin eater for sure. You definitely need more margin. Yeah. Okay. All right. I think I've gotten that. I think I've gotten the main idea. So I wasn't getting sued. I'm saying if you own a business, you can get sued. That's what I was saying. And so if how much I make is out there, then there's a chance that I have more exposure. It's about controlling risk. Benzinga, how would you spell out trading platform you mentioned? Think or swim? I can type it in for you here. Hopefully that answers your questions there. All right. Is a couple more questions. I want to look at a few more charts. And I want to kind of go over some ideas. Is options trading more enjoyable than futures and commodities trading? In my opinion, yes. In my opinion, yes. My personal experience and the reason why I enjoy options is because there are more ways to make money. If you are buying futures or selling futures, you're really a directional trader. And you have there's only so many ways you can make money doing that. But with options, I can make money if the market goes up. I can make money if the market goes down. I can make money if the market goes nowhere. I can make money if simply, let's say I was, and let's do this. This is one of the great things about options. Is that, so what if I bought the puts on the close of this day here? Let's say I bought the 460 puts, which would have been cheap. But let's say I bought these puts here. So we'll put a plus for puts at 460. Okay. And let's say the S&P 500 initially sold off, but didn't go anywhere. Well, I can make money simply by the fact that the implied volatility has increased, which would have increased the value or the premium of those long puts. So I don't necessarily have to be right on the direction. As long as the IV goes up, I could be making money. So I can be making money through direction or non-direction. I can be making money through time. I can be making money through volatility. I can make money while being wrong on direction, but just right on the premium going up. There's so many different ways to make money that for me, I look at it as just more opportunities. You know, in checkers, you only have so many moves. In chess, the pieces have way more moves. That's what options is. You know, most trading is like checkers. Options is like chess. The more moves and the more pieces you can make, the more things you can do with the board. Okay. So, all right. Great points, Chris. I definitely enjoy chess. All right. Oh, this is a great question, Sam. Excellent question. And then we'll get into some charts here. You can trade bidirectionally as well. Yeah, you can trade bidirectionally, but you're not going to make money via time or volatility or theta decay or things like that. So there's just so many different ways that you can make money in options that you can't while doing futures or stocks. This is an excellent question. What is the most common mistake option traders do? From my experience of seeing traders over and over again, it would be applying the wrong strategy for the wrong environment. Most beginning option traders, and understandably so, they're generally just doing long calls, long puts, that kind of thing, but they're not taking into volatility into account. They're not taking time decay into account. They're not taking a lot of things into account. And so I would probably say it would be the three biggest mistakes are not using the right strategy for the right environment. Maybe they get the direction right, but they're still using the wrong strategy, because there can be many strategies that can take advantage from an upward direction, but some strategies will be more tailored to that particular style of movement, high momentum, low momentum, mean momentum, whatever it is. So that'd be the first mistake. The second mistake I would say would be not understanding like market gamma and understanding how options flows really have an impact, how reflexive they are. So I would say that would be another big mistake. And then I think it also would be not understanding Greeks and pricing, the option Greeks and pricing, because to really understand options, you have to understand the Greeks. And if you don't understand the Greeks, then you don't, it's like not understanding how options function and work. And so you're really limited in their application. That was a great question. It was a very, very good question. Sam MD. So in order to avoid long trades, the account would need to be funded minimum 25K. You don't need 25K to avoid long trades. I think what you're saying is for day trading, the power day trading rule is 25,000. Correct. It's a great question. Mr. Goon says, I notice a lot of traders still holding long calls at expiry. Yeah, that's not understanding the mechanics of how options work. So yeah, super, super important. Gloria says, also when beginning option traders buy deep out of the money options. Yeah. I mean, there are certain environments where that can be really useful, but most beginning traders are doing that because they're the cheapest. The problem is if you're not looking at Greeks, if you're not looking at pricing, if you're not looking at the deltas on that, it could take a large move in the underlying before those things really start to gain in value or any significant value. That's why you have to understand the Greeks. I will smoke Chris in chess. Just I haven't played competitively in like almost a decade, so I will totally agree with you on that one. If price goes nowhere, oh, you can copy that. They're asking someone else on that. Can I answer about the discount thingy? That's I'll let Rodrigo answer that one there. Okay, a few more questions, and then I want to kind of get into. I'd like to share a trade idea or some trade ideas of how I'm looking to play things going forward, because we're all looking at the same right edge of the chart. But before that, let's see here. What do you recommend for a $1,000 account size to maximize gains as much as possible? Selling options, lower price stocks, 0 days to expiration or short time to expiration. I would not recommend massive holding times because then you have margin exposure for long periods of time. When you have smaller accounts, you don't want your capital to be there for long periods of time, because then that means your capital's not working for you. So let's say you have $1,000 account and you decide to sell some options and it requires $300 in margin. Okay, well, you've used 30% of your account just to do that one trade. And if that one trade isn't going to produce a profit or a decent profit for a month or 3 months or a year from now, you're really just doing one trade or maybe two trades. You're using a lot of your capital for only a few trades. And so it's going to take a while to turn that account over to grow the account size. You might nail that one trade, but then the problem is you're not getting feedback from the market. Every trade you do gives you feedback from the market. The market will let you know, this is a good trade. This is not a good trade. You did this right. You didn't do these things right. The market will communicate that to some degree. It's your job to learn the analytics to do the deeper analysis. But the bottom line is that if you only do one trade per year, you won't know whether you have the skills to be a good option trader for decades, because you're only getting a few trades per year. Whereas if you're constantly doing trades, every trade you do gives you feedback. As you take that feedback and information, you can integrate it, learn and adapt and adjust each time you get that feedback. So in the beginning, I recommend a lot of repetitions. Just like if you want to become a professional soccer player, basketball player, you don't play one game a year. We won't know if you're a good basketball player until you're like 50, and by then it's too late. No, we need you to play all the time to get that feedback and improve. So super important. Short dated options, generally selling daily or weekly premium. You want to build that up fast, because if you have a small account, you have a small room to work with. You know, you need to build that account up quickly. Your first goal should be to get it to like 10,000. Then from there, you want to get past the PDT rule. And then from there, then you have a lot more flexibility. So those should be your first few goals. And to do that, you're going to have to turn over trades really fast. Is it possible to know where you are in profit or loss throughout the day in your trade? Yes, but the Benzinga or the Thinkorswim platform has an options analytics tab, and it will show you the P&L curve of that option, you know, on closing date and on the current date. So yes, the Thinkorswim platform shows that. What are we going to do when you get to $25,000? I didn't say specifically what you're going to do, but that just gives you the option to start doing day tradings once you get past 25K to do the PDT. You have to have margin enabled to trade options. Probably depends upon your broker. I don't know. I've never had to face that question because I was above all that. I was instantly given a margin account when I opened my account. Okay, a few more questions. When do you get paid a premium on your trade? So technically, when you sell an option, you collect that premium. Your broker should be giving you a credit right away. Now, each broker is going to do it slightly differently when they give it to you. Thinkorswim does something interesting. So let's say I'm long 460, I'm long 1,000 shares of SPY at 460, and I decide to sell 10 calls at 475. Thinkorswim is going to give me that credit right away, but then the way they do it is as the option adjusts over time, they will either add or reduce the credit as it adjusts. And then by the time of expiration happens or whenever it's closed, it's already baked into your account, but it changes over time. Each broker is going to do it slightly differently. So yeah, so hopefully I answer your question, but you should be getting, most brokers should be giving you the credit right away. Now that doesn't mean you have access to the credit because you still have the trade open. The credit won't be finalized until you've closed it, then it needs to get settled. So yeah, but each broker would do it differently. Okay, let me get to YouTube real quick, and then let's take a look at the current market and how I'm going to play it. We got about another, Rodrigo, what are you thinking, about another 30 minutes?
Up to you, Chris, on your schedule. I know you have, things you have to do, but definitely appreciate the effort you've already put in all this time here to help everybody.
Cool.
So up to you.
Awesome. All right, let's do at least another 30 minutes. I'd like to answer a few more questions, and then I would like to show you how I'm planning on trading things going forward for the rest of the week. Joshua, I've answered your question. What is the minimum account size to trade options in this class? We don't require a certain account size, but you would be fine with 10,000. I've had success buying close to expiry near the current price, just above breakout, just for a few minutes or hours. Crazy how fast it runs. So you're doing short dated options, which really means you're looking for explosive gamma moves as possible. I mean, if you're selling options, that's very different, but it sounds like you're doing long options, 0 days to expiration or close to expiry. Really, you're looking for high gamma, high volatility moves. That's a great playbook, but I don't think it's the only playbook an option trader should have. Catchy's saying small accounts will be profitable. It's just hard. Sure, for sure. You always have more options with more capital, but you can't really think about it. You can't really think about it in the sense of, I wish I had a bigger account. Trust me, every single trader on the planet, even the largest account holders, wish they had a bigger account. The best thing you can do is just work with the account size you have and maximize your opportunities in the greatest possible way with the account size that you're working with. That's your job as a trader. Which platform do you recommend to be used in Canada? If you can use Thinkorswim, I recommend that. I don't know what other platforms are available to Canadians. So if you put that in there, I'll be happy to give some recommendations. With the 10K account, do you recommend larger trades and not as diversified, or more diversified but less returns per trade? I recommend smaller trades. That doesn't mean you shouldn't do some larger trades. If you get a really good opportunity, sure, without a doubt, definitely. But you don't want to take larger positions and overextend your risk by any means. You should always be controlling risk on every single trade. Every time I don't control risk, I regret it. Whether I win or lose, I still regret it because I don't ever want to build that habit. But yeah, I generally recommend smaller trades until you have, an account size where you can do a wide variety of trades, for all kinds of market directions, single stocks, ETFs, and things like that. I recommend smaller trades so you can ramp up the account faster, because again, while you're holding trades and you're holding margin, that margin's, kind of held hostage until you close the trade. And so that means a part of your account is not available to do other trades and make more money. So every time you put margin out there, put capital out there, you need that capital to be working for you. So it's super important that you get it to be working for you as fast as possible. If I have to sell options, do you have to own the stock of the same options ticker? No, you can do naked, but I don't recommend it. But you can sell spreads. You can sell things without owning the underlying for sure. There's plenty of ways you can sell spreads. You can sell iron butterflies without owning the underlying for sure. Which option strategy do you find most profitable? There's not a single strategy I find most profitable. The option strategy I find most profitable is the one that's best tailored to the current environment. And that will always be the case. I will be teaching. How many option strategies am I teaching in the school? I mean, it's like, I think it's like maybe close to 15 different option strategies. I mean, yeah, we're probably in like anywhere between 12 and 20 different option strategies. But we're not just teaching the strategies themselves, we're teaching you the most ideal environments to use them, which is super important, and how to use the underlying flows in the market to use the best. I go to real account. Okay, it's an interesting question, Amy M. I've been successful for 4 months in Thinkorswim paper trading options, but when I go to real account, I'm struggling. How do I account for the Thinkorswim paper lag for pricing? I don't think the lag in pricing is probably your biggest issue. From my experience of mentoring students for like 15, 16 years now, maybe 17. From my experience, when a trader does well on demo but doesn't do well on live, it's usually a mindset issue. And it could be because that when you're in demo, there's no real loss, so there's not as much pressure on you. You take more time. You know, you're not really worried about losing this money or anything like that. So you're not dealing with the emotions or the psychological aspect that can hamper your performance as a trader. You know, when you start trading real money, that everything changes. So that's why I recommend for most people, you know, starting out with a live account, even if it's a small account, just so you get that psychological conditioning in there. Interactive Brokers in Canada. I think Interactive Brokers is okay. I'm not really crazy about their customer support, but they do have a decent platform for sure. What is a naked call? It's selling a call without owning the underlying. I don't recommend selling options naked. I generally don't. That's why I said rarely ever. Just in case you don't realize your webcam is on, I do realize it's on. And as I said before, I don't recommend selling naked options. I've said that before. I don't recommend selling naked calls or selling naked puts unless you have a lot of experience and a lot of capital. But you can sell options without owning the underlying. You can sell spreads without owning the underlying, so it's not a big deal. Why don't you recommend naked options? Because the risk, if you like, for example, selling calls, your risk could be unlimited. You know, the market could go to infinity. You could be stuck in a situation like this. And what was the day? You could be stuck in a situation like this. Yesterday, the day before this move, you sold the 200 calls, car rockets to 543, your account's blown up. And you probably owe the broker money because your risk is unlimited when you do not own the underlying. If you sell naked puts, your risk is almost unlimited. The market can go to zero. So your risk is limited to that. But if car drops from 185 to zero, you're going to lose so much money that it would just be too brutal. Again, your first job as a trader is to control risk. Once you've done that, then you can start looking for alpha from the markets. If you don't control risk, then you're going to lose your profits. So that's why I mentioned that. Is there such a thing as option screener or scanner defines options worth trading? Yes, Thinkorswim has one. Okay. All right. Let me use this last 20 minutes. I've been speaking a lot today, so my voice is starting to get there. So I would like to use the last 20 minutes to kind of talk about, you know, how I'm approaching the markets going forward from here forward. So, and what I'm thinking is, you know, the potential scenarios. As a trader, you always have to have this kind of if-then approach to the markets. You know, of course you can have a bias, but you can have a bias. People say don't have a bias. And I say, no, you can have a bias, just don't be married to it. Having a bias or not having a bias isn't the problem. Being married or attached to your bias is the problem. So for those, you know, people who say trade without a bias, I say BS. Your brain is automatically going to have a bias if you understand how the brain works. And I do study neuroscience in college. I'm going for my PhD in neuroscience. your brain will automatically have a bias. It's always doing probability calculations, not just in trading, but in everything you do. So your brain will have a bias. And so the bias isn't a problem. Being attached to the bias or married to the bias is. And so with that being said, you always have to have an if-then approach to the markets. You believe certain things going to happen based upon the probabilities, based upon your experience, based upon your analysis. But by having this if-then approach, you're basically saying, if the market does this, then I want to do this. But if the market does this, then I want to do this. And the more experience you get, the more subtle and nuanced that approach will become. So what am I thinking is the likely scenarios for the market the rest of the week? I have stated this pretty clearly. I wrote the Benzinga article about it, told my students, but I think there is, if not Wednesday, then by Friday, there is a really good chance that we see a big expansion in market volatility. By the time the options have expired on Friday, or after this expiry, I'm expecting a big expansion in volatility next week. It's the monthly OPEX. It's the end of the year. A lot of traders aren't going to be wanting holding positions for the last 2 weeks. It's low liquidity. There's bad breadth in the markets right now. There's a lot of mechanics and dynamics in the market that will lower liquidity, create problems. Traders aren't going to want to hold positions. Traders are going to want to sell their stocks for tax purposes. So my prediction is starting Monday next week, volatility increases massively. It could even start tomorrow, depending upon where the Fed lines up. They may line up super hawkish. They may have serious concern about inflation. They may, really adjust their tapering, approach. Any one of those things could kick off a lot of volatility. So we have the Fed tomorrow, which could kick off a lot of volatility. If it's a nothing burger, then you'll probably see a couple things happen. You'll probably see a lot of this short dated long put exposure that people have been buying over the last few days. So this right here is a lot of long put exposure. You'll probably see a lot of those be unwound. And if those long puts are being unwound, then that should create a tailwind for equities. But if it's a nothing burger, we might not see a whole lot of volatility from that. It will depend upon how fast people close those long puts and how much those long puts or how quickly they're unwound. But by Friday, we have a lot of options unwinding in the market. And that's going to reset the options board, and that should create a lot of volatility in the market. So I'm looking for long volatility plays. That could be long straddles if the pricing is good. I could wait for the volatility to expand and then look at calendar spreads. I could be looking for directional plays that will take advantage of the volatility. There's some that take advantage of volatility, some that don't. So there's definitely multiple ways that I can attack it. And so most likely leading into the FOMC, you're going to see volatility contract. You're going to see flows contract. You're going to see price ranges contract as a whole. Assuming there's no Fed leak, that's probably what's going to happen. And then depending upon the FOMC plays out, we could see a massive expansion of volatility, or we could just see, hey, it's a nothing burger. These puts are unwound, get a little tailwind for equities. So I like looking at long volatility plays through the end of the week towards the next week, maybe even towards the end of the year. So those are some ways about how I'm playing it. And there are definitely a lot of ways you can do long volatility. You can do long straddles, depending upon, whether you want to do ratio spreads or not, you can do that. If you feel comfortable enough, you can do calendar spreads, but you'd want to wait till the volatility expression changes and this term structure changes. You want to do that. So there's a lot of different ways to play it. I would not want to be playing short volatility or volatility contraction strategies over the next week or two, because I think we're going to see a massive expansion. We just have too many events lined up in succession that should unlock this market in a very serious way, up or down. And so that's what I'm looking going forward. All right. Smash the like button. Appreciate it. If you haven't already, hit that like button. We do appreciate it. We do appreciate it. All right. Let's just looking through the questions real quick. Just trying to see if there's something. What strategy or discipline do you use to bail out of your underwater losing option positions? You should have, before you go into any trade, Ishlamas, I hope I said your name right. You should have an idea before you get into the trade what your max risk that you are willing to accept on the trade is. If you are past that, from my experience, the best thing you do is just close it right now, be out of it. Because if you're past your risk parameters, you are now outside of risk tolerance. And I don't recommend being in the state of mind of like, wow, I just made a mistake. I really kind of screwed up. I'm over risk right now. Most traders aren't in a good mental state in that period of time. And so the best thing to do is just cut, learn your lesson, review the trade, figure out what you did wrong, figure out what you did right, reinforce the good things, learn from the bad things, and move forward. From my experience, more often than not, it's better to just cut and be done with it at that point. If you're more sophisticated, you're more experienced, and you're not outside your risk profile, but you're kind of getting towards that barrier, then I will look at various, depending upon the position, the stock, the volatility, the price action, the gamma structure, and everything like that. Then I'll look at what's the best for that. And there's no way for me to answer that because I don't know that trade. But my suggestion is if you've violated your risk protocols, your trading plan, cut it, learn, move on. It tends to be the best thing. Hi, Kristen B. Chi-Chan, good to see you. I need to go. Enjoy the rest of the meeting. Thank you. It's good to see you, Chi-Chan. How to find a good option trade? What do you look for before entering the trade? So Deepak, we've talked about this already. So you have to understand, to find a good high quality trade and option, you have to understand what's going on in the price section, what's going on in the volatility, what's going on in the direction and momentum. Where is the open interest lined up? Where is the market gamma lined up? Where is the potential hedging impacts on the market and how will that affect it? You know, people like to think that, you know, option dealers and market makers don't have an influence on it. Then what is a gamma squeeze? You know, a gamma squeeze is, you know, if you think about what a gamma squeeze is, and there are two ways a gamma squeeze can happen, but a gamma squeeze, the most typical one, is option traders looking at single stocks. They are buying large amounts of calls. The dealer has no exposure to that stock. So they're buying like whatever, 100 calls, 1,000 calls or something like that. Dealers then short 100 calls. So to offset the directional exposure, which is to the upside, they're going to get long shares. And as the gamma starts to accelerate and the buying continues to accelerate, the dealers are trading with the market. That further exacerbates the market. They're adding liquidity to the market in the direction of that squeeze. And so if you understand how gamma works, when you're long gamma, gamma works with you. When you're short gamma, gamma works against you. And so you have to understand how gamma accelerates as the market continues to rise. And so, you know, there is that reflexivity of the markets. Option traders have to understand that. If you don't understand that, you could be caught on the wrong side of a volatility move that's really just reflexive buying and selling, but you're stuck on the wrong side of that. You have to understand these mechanics. Super, super important. Can you touch on your stop strategy based on underlying or options? That's such a broad question. It's going to be different for each one. So, you know, yeah, that's such a broad question. You know, that would be the kind of thing that we'd unfold over days or weeks. It's going to depend upon the options, it's going to depend upon the price action, the volatility, all those things. There's no like one fixed strategy because volatility has an infinite amount of expressions. Price action has an infinite amount of expressions. And so because of that, you can't have one stop for every type of trade you can get in. You can have a risk tolerance, but you can't have a fixed stop for every strategy. All right. What is considered a small trade in a 10K account? I think you mean like a small individual trade, one contract. but it depends upon the size of the contract, because not each contract, the premium is going to change based upon the stock. So, anything that's like what, a 0.1%, $100 would be what, 0.1%? No, would they be? $100 would be 1,000 is 10%. $100 is 1%. So $10 would be like 0.1%. What options do we have if we don't get your lessons the first or second time? What is the support after the class? So Sandy, you get access for the whole year, and we repeat the lessons every 2 weeks. So if you miss them, you can always come back and catch the next cycle, but also we also record the lessons. So you can always access the recordings. Is naked the same as single call and put options? No, they're not the same. If I am selling a call without owning the underlying, that's a naked call, but I could buy a single call, and I could be, I could be long a call, and that's still a single call. That's still a single leg option. So it's not the same. Any opinion on using Schwab? I haven't used them, but if you like the user interface and you get the necessary data on the option chain, and you're able to get all the data you need to out of that platform, stick with it. I am platform agnostic to some degree. If you sell naked calls and you don't have the money or margin to buy the stock, you lose money. Does your broker come for you? Yeah, they're going to issue a margin call, and then you're gonna owe them money. Are they going to come for you? They're not going to like show up at your door. But okay, great question. Santa Claus rally the next few weeks. I believe the market is primed for a Santa Claus rally, but that's going to depend upon the Fed. If the Fed comes out with some bad news, then we could have some problems. There's two things that could really help this end of the year rally, which is one, we get a nothing burger out of the Fed, and two, traders start building up calls at or above the current strikes. The last few days, we've seen a lot of short dated put exposure. That's why we sold off pretty aggressively. We've seen a lot of buildup in short dated put exposure. Those puts need to keep declining. Like the market needs to keep declining for those puts to keep maintaining or gaining in value, because they're losing theta every single day. If they're short dated, they're going to lose a decent chunk of money on Wednesday and a lot on Thursday and Friday. So they need the market to keep going down at increasing amounts just to keep up with the theta decay. So if the markets don't do that, then you're going to see a lot of these long puts unwound, and that will create a tailwind for equities. So the market is kind of primed for that. My, overall feeling is I want SPX to stay above 4,600, 4,601. Once we get below that, really once we start to get below 4,586, the market architecture really changes. The gamma architecture changes, and it becomes very deep or more destabilizing at that point. If we stay above this kind of zone here, then we're in this kind of positive gamma environment, which is much more stabilizing for it. But once we start to lose that, things change. So the market is primed for an end of year rally. And I think statistically, like 15 out of 20 of the, not in a row per se, but 15 out of the last 20 Decembers have had this kind of rally, this Christmas rally. So after the OPEX. So I think the market is primed for it, but everything really depends upon the FOMC tomorrow. Is there a way to know drop in open interest in real time? You can get some of that information via your platform. There are certain services that will collate that data. I am working with Benzinga to eventually build that. Cypher DMG, when you said high volatility, did you mean either way? Yes, volatility doesn't have to be one way or another. Volatility is simply the capacity of the market to move up or down. So for example, let's move this chart over. So we're just all white. These are two different volatility expressions of the same stock. So you have a stock at 445, stock at 445. The ability of the stock to move, say, a few bucks up and a few bucks down is a certain level of volatility. If that same stock over the same period of time can move double that difference, that's a different expression of volatility. That's an increase in volatility. Volatility does not have to be directional. It's just the ability or capacity of the market to move and change prices over a period of time. And the more it can do that, then the greater the volatility is. So that's really what volatility is a measure of. So hopefully I answered your question. It's not, when I talk about high volatility, it's not a question of direction. It's a question of expression or the capacity to move up or down within a period of time. So hopefully I answered your question. What if you only have 3K trades initially? Then you just have to be pretty precise about your options. Short dated, my recommendation, sell premium a lot. If you're going to buy, you need to be very, very confident and very impatient with your trades in the sense of you don't want to hold those for long periods of time. How do I get the class times? Rodrigo, do you have the class times? We should have them. I'm pretty sure I know the first class starts at 10 a.m., but if you could say that real quick, that'd be awesome.
Yeah, absolutely, guys. I posted it in the chat, but I'm gonna go over it now. So Monday to Thursday, the lesson is 10 a.m. to 10:45 lesson lecture, 10:45 to 12 lesson Q&A and current market examples, 3 to 4 lesson review and open market discussion. And on Fridays, you meet from 1 to 2 p.m. for class reviews and open student Q&A. So a lot of support, a lot of times for you to be able to interact with Chris here and be able to, not just with Chris, but with the other students as well. It's a great community.
Tia Gaylor also said, I work, so classes will only be available in the morning. So we just gave the times, but they are recorded, so you can always access them later. Yes, this is a great question. Chris, do you ever try, it's a great question. Chris, do you ever try trading a small account, 1,000 or so, just for the challenge? Not really. I really don't buy into the small challenges. And here's the reason why. You know, generally when you see a trader or a mentor doing a small account challenge, they're not doing it for their own trading account benefit. They're doing it for two reasons. One, they're trying to show you, the smaller retail account trader, like, look, you can make a lot of money with just a small account. You just need to learn my strategies. But here's the difference, is that you've never done that before. The professional trader has. And so because the professional trader has that experience, it's much easier to do it with a small account than somebody who's never done it before. So for me, small account challenges really aren't worth it because I only have so much time on this earth. My time is, I don't have unlimited time. I have a limited amount of time. I don't want to work or, be trading like at 90 years of age. I want to make my money and then retire. And so that means that for every day I'm in the markets, I need to be utilizing my capital in the best way possible. If I purely wanted to gain sales, then I might do that. But again, it's not as authentic as somebody who's trading a small account for their first time and never built it up. So to me, small account challenges are a marketing thing. They're not you're not going to see George Soros be like, I opened up a $10,000 account and watch me grow this thing to $1 million. It's a waste of their time. It's a marketing thing. So yeah, hopefully I answer your question. Do you recommend setting long trade closer in the money in the future due to growth concerns in 22? Setting long-term, I think what you're saying, Patrick Vilbun, is, do you recommend to setting long-term trades, like long-dated expiries, closer into money in the future due to growth concerns in 2022? Is that the question you're asking, Patrick? Help me out so I can understand it. Roughly how many students in the class? It's unlimited as far as I can tell. There's no limit to that. Michael Shu is saying, if you think a stock will be bullish for the next few weeks, which option strategy has small risk and decent profit if you get it right? That's going to depend, because bullish, how bullish? Mildly bullish, high volatility, low momentum, it all matters. So we had covered this earlier. You have to have, getting the direction right is only one aspect of the trading options. You have to also get the expression of volatility. And if you're long options, then you're going to be exposed to time. So it has to be the fastest movement over the shortest period of time. There's no one answer to that, because there's many different expressions of how that can work out.
And the key is to understand the differences. Everyone talks about Santa Claus as it like spies going past the moon and Mars. It just means the market usually goes up before Christmas. Even just a single cent is up. Technically, that's correct. But, yeah, I mean, it doesn't really matter what people talk about. What really matters is the market primed for a rally? And I think there is. I think there's some priming for that, but we need some other things to come in. Junior Academia says when to sell an option for a loss percent. You should have that fixed rule ahead of time. You should have that ahead of time. If you've hit your max risk on that, you should close. You should have a fixed idea of what is the max loss you're willing to take for that option before you get into it. And so you need to have that ahead of time. If you violate that, you need to be out. But there's no fixed answer for that. I don't believe in the idea of close it out at 25% or 50%. If the market gamma is favorable for the market to keep moving or to recover or to rebound or volatility or things to change in your direction, I think it's a totally insane idea to be like, oh, I've hit 25%, oh, I've hit 50% or 75%. I know Tastyworks does a lot. I don't buy it because the bottom line is the market doesn't care whether you're up 25, 50 or 75% profit or down 25, 50 or 75%. The market does not care. It's going to do what it's going to do. And if you're pretty good at reading the market, you might be down 75%, but like, oh, Tastyworks says I should be down at this percent. I don't buy it because the market might be saying, look, this is the bottom here. The dealers are going to start hedging. They're going to start buying at this level. You could be getting out because of a fixed percent, but then the market could turn around. So you need to have like your max loss decided ahead of time. But if you're good at reading the tea leaves, you'll know like, this is going unfavorable. I'll get out now. Or no, this is going really favorable. I should stay in this. Or it's going to turn around. I'm going to stay in this. Never trade on a fixed percent. I don't buy that. Markets don't care about your fixed percent ideas. They will do what they want to do. Is there for a VIX for NQ? Yes, VXN. Yes. There it is. Okay. All right. Answer all those. Are we able to access Chris chat for query if we have doubts? We will have a chat room in the Benzinga Option School, and I will be holding office hours at specific times. And so during those office hours, absolutely. During the classes, absolutely. Outside of that, no, I'm not a robot. I can't clone myself. There's only so many hours in a day I can be available. But yes, during those hours, I will be there live and also in the chat. All right, we are at 4 o'clock. I want to do a few more questions and I want to wrap it up. Thanks for saying good session. Glad to have you here. Thanks for the session and thanks for coming by. Hope it's a rally. I need a Christmas cash bad. Remember, hope is not a strategy. I mean, you can always hope, but don't rely upon hope as a strategy. Always rely upon what the market is giving you. Is it an ET or PST? So the class, I believe the times that Rodrigo gave it are in EST. Yeah. So 10 a.m. Eastern, which is 7 a.m. Pacific. I'm in Pacific, but it starts at 10 a.m. Eastern. And it's snowing again outside. Our class is recorded. Yes, they are recorded. Covered that. Is there a way to set alerts in Benzinga Pro for an IV ceiling alert? Notify me when Apple IV hits 35. That's a good question. If they don't have that, I am not just here to teach the Benzinga Option School. I'm also here to help build an options program and technologies and apps and features with Benzinga. So it is my goal to not just teach a huge generation of traders, many generations of traders to become profitable at options, to build their skills in options, to find a strategy that works for them. But I also want to improve the Benzinga offerings in terms of options. So if they don't have that feature, then I think it's a great feature. I think that'd be something great to build into the Benzinga Pro app. My hope is to continue to build new technologies into Benzinga. Thank you, Mark. Good to see you. Justin Goodman says 9% of traders fail to maintain profitability. You have to flip the script from what everyone else is doing. Chris knows how to flip that script. Thank you. I appreciate that. Will there be a recording of this webinar uploaded somewhere? Rodrigo can answer that. Opinions on using TradeStation. I haven't used it, but my general thoughts are, if you like the platform, it gives you the information that you need to make your decisions. You like the user interface, stick with it. Torsten, good to see you. I know, 1 a.m. your time. It's good seeing you. Be well. TOS does have alerts on AV. That's good to know. Thank you for that, Justin. Eventually, I'd like to build that in Benzinga if they don't have it. How many options do you normally have open at any time? I think I just did an analysis. I think 34. I think I have 34 different instruments, different underlyings that I have positions on right now. I think it's about 34, and I have options on about 70 or 80% of them. So whatever that math is, about 23, 24 options, whatever, open right now. I usually am running 25 to 30 trades open at any one time. That's a great question. Okay, I've answered that. I've answered that. At work, so classes will only be available in the mornings. Yeah, we have the 2 class times. Rodrigo will cover that, but again, they're recorded, so you can come in later. And then we have office hours on Friday as well. Cypher DNG, I'm excited about this, and it was great meeting you. It was a pleasure meeting you, Cypher. I know this is going to complement the base trading school, which has improved my trading skills. I'm glad to hear. I've heard great things about the Benzinga trading school, and I think this is just going to be another extension on top of it. And it's going to give you a whole new set of skills to make money in the markets that you can't just by buying and selling the underlying. If someone works 9 to 5, how much harder is it for someone to learn from recordings after market hours? Well, you just have to work with the limitations that you have. And so you can either take this opportunity to learn or not. There's a difference between someone learning to play basketball who has all day versus someone who has a 9 to 5 job. It's not a question of you just have to work with the limitations you have and maximize those opportunities. I have most of my students have full-time jobs. So, and they make it work. You just have to be very efficient with your time, very disciplined, very scheduled with your time that you have. So yeah, Gary R says, nicely done. Be seeing a lot of you next year. Good to see you as well. Max Planck, Rodrigo can answer that question for you. Scar Joe Rabbit, good name. What percentage of your portfolio is used for long-term holding, swing trades, options? I haven't broke it down fully. I have to look at it a little bit further, and it's hard to say that because I have a lot of short-term options that are coming in, coming out. And so, there's a difference between what's open and what I have already executed. So I don't really calculate that because it's not too valuable for me. Holding times is a valuable statistic. Like my trading journal will break it down. Hey, you do better when you hold it for this amount of time versus this amount of time. But I don't have it broken down into long-term holding, swing trades, and options. I always have, there's separate accounts for me. My long-term account, completely separate account than my swing trading and short trading account. So yeah, they're separate accounts completely for that. Can I please do one ticker? Sure, let's do that. Let's do that, and then we'll wrap it up with that. All right, let's get rid of CAR. By the way, I was on Benzinga the last 2 Mondays. I said CAR was going to go down. It's gone down once again. Let's do Affirm. Okay, so let me look at the 4 time frames, and let me see what's going on in the overall flows of Affirm. Okay, so prior to today, I haven't looked at today's options, but prior to today, and I can look at today's options. So prior to today, Affirm had about 280,000 calls, 145,000 puts, and today alone executed 98,000 options. That's a lot. That's a lot of options. So prior to today, the stock had roughly 430,000 options, and it's executed about 100,000 on the day. That's about 22% of the options. That's high. Anytime the stock has 10% of the total flows within one day, I consider that strong flows. Now, with that being said, let's take a look at a few other data points here. Okay, so prior to today, I haven't looked at the short-term flows expiring this Friday, but prior to today, about 25% of the options in a firm are expiring this Friday. So of that 425,000, about 105,000 are expiring this Friday. That should unlock a lot of volatility in a firm. Today alone, not a whole lot of short dated, but probably about 15 to 20,000. So about 15 and 20% of all the flows today are short dated. So again, that's going to add to that pool of short dated options expiring this Friday. So we should see an expansion of volatility up or down in a firm. Now, with that being said, am I bearish or bullish on a firm? I am bearish on a firm. It is sitting at an important level, but I am bearish. And if you look at the charts, it's kind of hard not to be bearish. So 1, 2, 3, 4, 5, 6. Closing bearish 4 out of the last 6 weeks. Not good, assuming this week closes down. We've lost in the last 6 weeks, 1, 2, 3, 4, 5, 6, 7, 8 weeks worth of gains. As they say, you take the stairs up, elevator down. And so I'm leaning towards the bearish side on this. Would I want to sell at current levels? No. Would I want to sell on a rally? Sure, absolutely. Where would I want to sell? And again, remember I said it looks bearish, not just on the weekly. It's also on this here. So you got a pretty wide channel. So I wouldn't want to be like long puts on this one because of the swing nature of this. There'd be other options that would be better for this. But what are you seeing? Lower high, lower high, lower high. Strong selling over the last few sessions. And you're seeing lower lows, lower lows. If this low breaks this low, the structure is continued. There's no transitions yet in the price action. I see no real changes in the order flow. So I would be bearish on this right now. Yeah, I would be bearish on this. Where would I want to sell? What are we at? 105. I think the earliest I'd want to sell 110. Well, would I sell that pullback to 108.42? Maybe. The earliest, I really like selling at 110. And then I'd really like selling at 120. So because this channel hasn't changed in structure, let me get some lines on this. Let's get another line. If this breaks this low and makes a new low, then, and the channel keeps playing itself out, it should give him a swing. And that pullback, I would take that swing to sell. If I was going to day trade this, the last 2 sessions, the weekly view up has been holding. So weak corrective pullbacks into that. Get long puts probably, just depends. Short-term expiry. But yeah, I'm bearish on this. Price action, order flow, option positioning, all lean into bearish on this. So yes. Okay, Kylo, I hope that answers your question there. Rodrigo, I think that's a pretty good way to end it. Are you cool with that? You feel like we've done the job?
Yeah, I think it's been an amazing session here, Chris, and definitely we appreciate your time here to helping the Benzinga community be able to navigate the markets. It's been great here. I've had a great time. I'm going to stick around for a little bit, answering some questions on the Benzinga Option School about the subscription and such. But definitely big shout out to Chris Capre for joining us here. Definitely appreciate it, Chris.
Oh, it was a great session. Great questions, everybody here, Zinger Nation, YouTube, Zoom, and everybody like that. Some awesome questions. My hope for today is that you now look at the market differently. You look at options differently. Most of what you see in options education out there is somewhat vanilla. There are some really excellent players out there, but they're few and far between. My job as an options trader and mentor is to shorten the process for you. I've spent years learning options. And if I could take the information I had now and give it to myself on day one of options, I would be able to shorten my learning curve immensely. And that's what I'm trying to do for you guys as well. But it's really to kind of pull back the curtain and give you a chance to look under this hood to really understand how options work on the mechanics and the dynamics and that reflexivity. Because remember, reflexivity, that means predictability when you can learn to understand that reflexivity. And so my job is to teach you these skills and the strategies and the methodologies so that you can extract money out of the market consistently. And so that's what we're going to be doing for the members of the Benzinga Option School. So thanks to Rodrigo for hosting this. I appreciate it. Awesome working with you, and I will definitely see you soon.
Absolutely. Excited to get started, Chris. Thanks for being here with us.
Good seeing you. Be well.
All right, sir, you too. All right, guys, I'm going to show you guys the syllabus here really quick. You can see on the screen all of the chapters. I'm going to try to zoom in. And there are some descriptions as well on what each chapter is. Let me know if you can read that. So today is the inauguration of the Benzinga Option School with Chief Educator Chris Capre. He's going to be going over, these are the chapters, and obviously as we progress in the school, the education will get more tailored to what you guys are asking. You know, this is totally customized. It's for you guys. So you guys lead the education. You guys lead Chris on what you guys will be discussing, you know, during the open market discussion, guys. So I think you guys can read that. It's about 8 chapters. Yeah, if you guys want this document, send me an email and I'll send it to you guys. I'm going to put the contact there. 1 second. So you guys are the first ones to join pretty much because we launched it today. So if you join today, you're pretty much, you know, some of the first folks to join here. So introduction to options, understanding the Greeks, option volatility, single, 2, 3, and 4 legged option strategies, and how to use them, right? Knowing how to use all of these strategies. No trading, there's not a computer with this. You do get access to Benzinga Pro. So Benzinga Pro is included, and I'll go over some things in Pro later on. All right, so and this is the schedule, right? So this is the actual Monday schedule, 10 a.m. All this is in Eastern time. So Monday, Tuesday, it's pretty much repetitive until Friday, where you have the full recap of the lesson. And anytime there are significant market moves, we will cover them in the lesson review and open market discussion. So this is pretty much for you guys, for the students, to be able to take advantage of this, not just improve your trading, but learn what you're doing, trade with a verified community, the Benzinga community. And we have people from all over the world signing up, and it's pretty encouraging to see that you guys take the education seriously. It's very, very good. All right, Richard. Yep. Yep, I can see that. So Esteban, this is the Benzinga Option School. These are classes Monday to Friday with the instructor, Chris Capre. And in the lessons, you have about 8 chapters. These are the ones that I'm putting here on the screen. So this is basically the foundation of what you will be going over. And that's for every lesson. Every lesson is different. You'll be going over the markets, applying it to the current market conditions, and a topic overview of the market, which is important as well. That's what Chris was doing, talking about the market situation scenario, what strategies would fit this current market condition that we are in right now. So it's tailored to what's happening in the markets today. Obviously, like applying it, the education, right? And keep in mind, these classes are rolling. So next year, they're always going to be live and the recordings are always going to be there. You're going to have a trading chat room with Chris Capre where he's going to post his trade ideas separate from all the other chat, all the other noise. You're just going to focus on his setups and, you know, that kind of stuff. Then you're going to have a chat room just for the students where you guys are going to interact among yourself, share research, all that kind of stuff, setups, and help each other out as well. And you will also have a chat room inside the live class. The live class, when Chris Capre is teaching, you will be in a chat room that is just for the live class. And your questions there are, regarding the actual lesson. Like if you need like an explanation or something like that, that kind of stuff. Yeah, correct. Yeah, Richard, it's different. So if you guys have questions, just post them in the chat. I'm going to drop the link there one more time. This deal expires at midnight. The link that I'm posting here basically does have that discount applied as well, guys. All right, guys, if you have any, Amir is asking if the courses are on Zoom. No, they're going to be in the Benzinga options platform. So we have a trading school, options school platform, and the classes are inside that portal. There is a 7-day money back guarantee trading STK. So if for any reason, the classes are starting January 10th as well. So right now you will have immediate access to Benzinga Pro. So that's what I'm showing you guys right here. This is the market research tool. It's the only and I wouldn't even call it competition, but we're focused on helping retail traders. So a lot of the things you see here, like the tools that we've built in, are made for retail traders, totally customizable. And even though equity firms and funds do use Benzinga Pro, mainly because how tailored we are towards who we service, right? Retail traders, day traders, swing traders, option traders. So all of the things you see inside Benzinga Pro, all of the tools that you can use here, these all came from either feedback or brainstorming or just actual traders basically trying to provide a better tool. So Benzinga Pro is like a tool of itself. You can literally just use this and get the education and then go back to the chat room with Chris Capre and the other students, and you chop it out and you talk about these setups and you share your research, right? More trade ideas flowing. And if it's something appealing, you guys bring it up to Chris during one of the classes so that he can check it out and take a look at it. So, with a 72% profit in 2020, I don't know a lot of funds that were even halfway close to that. When it comes to that kind of trading. So all of these tools and things that you get in Benzinga Pro, you just bring them back to the option school and talk about it with Chris. How many weeks is the course? Kunga, the course is rolling. We don't have it's not a start finish because it's rolling with the current markets. The subscription is for 1 year. So, even though in 1 year the subscription would finish, it doesn't mean that we stop, because the classes are rolling and we pretty much record again all of the live sessions, because this is all applicable to the current market conditions as well. Whenever you're getting like either trade ideas or research and how to apply it to certain setups and stocks. No, if you have Benzinga Pro, there is no discount, Kunga, but reach out to me and maybe I can do something for you. I'll put my contact there in the chat. So the actual subscription is for a year. The course, I mean, education is a lifelong process, man. Like it's not like if Chris has been doing this for like 2 decades, you're obviously going to be way better off after that year for sure. But it's all about like keeping the razor sharp, making sure that you're always learning as you go, because there's a lot to learn, to be honest. It's not just what is a call or what is a put. There's a lot of thought process behind that. So I dropped the link in there, Kunga. Mel, 7 days. So 7 days from when you sign up is the money back guarantee, Mel. This deal though expires at midnight. So you guys, as the first members of the option school, you guys get dibs and you get this discount that we have right now. So it comes with Benzinga Pro. It comes with the entire Benzinga option school, and that does come with the chat room for trading with Chris Capre. And you get all the community. You're going to have access to a whole bunch of tools and research material inside Benzinga Pro, on top of all of the research and commentary that you guys will get from Chris Capre. So it's definitely something that if you are starting options, you might want to look into it. The lessons will start on January 10th. That's correct. Right now, you guys would have immediate access to Benzinga Pro, and you're locking in the deal that you guys get, the early bird deal, before we do start the classes officially in January 10th. That's correct. And all the classes will be recorded. So in case you missed them for any reason, I saw that a lot of people here, might have like a part-time or a 9 to 5. Everything will be uploaded to the portal. That way you don't miss any lesson. You don't miss anything. You're going to be able to look at this whenever you have the spare time, which I would put the time into it. It's a very great skill. It's a revenue generating skill set, and building on it only helps you. So Richard, you know it, man. Like, education is a lifelong thing. You can't just put the book down and say I know everything. But you have people that have experience, and that always helps. But the market is teaching things to hedge fund managers every single day. And nobody knows what's happening with the markets right now because it's so complex. So this is where experience kicks in, I would say. Absolutely. Brian is asking, all right, Dorji. All right, Mel. Yeah. So you can evaluate. You have the 7 days to evaluate in the syllabus. I put my contact there. You can email me and I'll send you the syllabus. Glenn, I'm posting the link so you can join in the chat. 1 second. So Mel, you get the 7 days, and in those 7 days, I mean, right now from the syllabus, since the classes will begin in January 10th, but I'm pretty sure you got a good feel about Chris Capre tonight. Dorji, the amount down start on Jan 10th. Dorji, so basically right now you would get the early bird special before the classes begin, which is when prices will be going back up. So you're locking in the discount. This is a permanent discount. It's not introductory. That means that you do keep that discount next year, and it's yearly. So as you renew, without the discount, it's like $4,000, something like that, Eric. And we're not even including there the trade idea chat room from Chris Capre. We bundled it in, but we didn't apply it to the discount or anything. No, Mel, you would the refund is for 7 days from when you sign up. So pretty much the classes will be starting in January 10th. That is correct. Right now, this is the early bird special. We do have limited spots here, so keep that in mind. Brian, how long are the recordings available? Brian, the recordings are going to be available forever. The classes are live. So let's say Chris would finish a class today. He just finished, the 4 p.m. Roundup that you guys will have on, Monday, Tuesday. And then that would be immediately uploaded to the portal, so that if you missed it, or if, maybe you want to watch it again, you can just hit kind of rewind inside the portal, but you can also find it in the video library. They're always going to be uploaded there. We have a full team of people working on this nonstop. So you guys don't worry about it. You guys will make sure to have every single recording available. You can watch it at your own time, for sure. Mel, send me an email. Maybe we can work something here. Let's see. Catchy. Can trading on the side of a 9 to 5 be written off? I don't know. You'd have to talk to your accountant. Maybe. Definitely that's what you should do. Talk to an accountant. So Scott, I'm gonna put in the screen what are you asking for? Times. All right. So in the screen, you can see the times here. See, Monday is the first day. So Monday to Thursday, it's the same schedule. It doesn't change. 10 a.m. to 10:45 lecture, 10:45 to 12 lesson Q&A, and current market examples. See, the keyword there is current, right? current market examples. 3 to 4 p.m. lesson review and open market discussion of the current market and other questions you guys have about options or trade setups, trade ideas, maybe you want Chris to look at. And then on Friday, you meet from 1 to 2 and you have a class review of all of the chapters that you saw during the week and open student Q&A. So that means that you guys will have an opportunity, open mic forum style, where you talk to Chris about whatever you want to ask him about, or feedback on your trades, or if you're underwater or on a trade and you need some help, that kind of stuff. You're welcome, Glenn. So, all right, guys. So I'm going to just leave the links here in the chat. I have a bunch of emails here from you guys that I need to follow up. Make sure that you do sign up before midnight. That's when the deal expires. If you have questions, you can contact me. I'll put the information below. Nicker, go ahead, answer. I'm sorry, ask your question on the YouTube chat. You guys are welcome. No, good stuff. I'm pumped. I'm excited. This is great. I'll give you some time, Nicker, in the YouTube. I know there's like a little delay. And I'll drop the contact if any of you guys have questions on joining the option school that we are launching today, inauguration night here. So some good things, some cool things happening at Benzinga. Glad that you guys are part of it here with us tonight. All right, guys, I left the links there if you want to contact me or have a question about the school. I left the link if you guys want to join. Expires at midnight. Keep in mind, Chris Capre, you guys are going to be able to, with Chris Capre, you're going to be able to basically talk about questions that you have and all that stuff. So let us know, guys, if you have questions. I left the links there. Thank you very much for joining here, guys, and have a great evening, guys.